Hey, what's up? Welcome to DGenEd. That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts. And so here, this is pre-market prep for Tuesday, March 4th. I'm going to be going over the usual tickers, and then I will be going over the Plug Power chart and tuning into their earnings call in about 27 minutes, starting the stream a little late, but give me a break. All right, so we're going to start over here as usual with the UVIX. This is the 2x long VIX futures ETF. And zoomed out a little bit, so just going to zoom in. And I have to say that yesterday's thumbnail for pre-market prep was Trump pulling a green rabbit out of a hat, being a magician. And I got that wrong, and it looks like that magician pulled a fast one on us, and that green rabbit turned red. I was thinking that the UVIX would be topping, or did top, on Friday last week, but we blew well past that high, hitting a high yesterday during market hours of 38.63 and closing at 36.89, and we're actually going even higher than this in the pre-market, up around 39.60, up over 7% in the pre-market. So we'll have to look over there, but maybe we do come down a little bit when market opens, and this is the high for the candle. So I'm just going to adjust these boxes, but really, maybe I should do this as I got to be disciplined, and 2 weeks. So let's do 10 bars coming out to here. So that is where this green box should be going. We could still be going higher for the next few days. And so that high, as of right now, is 38.63. And then following that, that is when we could potentially be getting into this red box territory, and that would be 10 trading days from over here. And so that would be something like that. And so I'm just going to make that top 38.63. So we got that there, and actually I'm just going to make sure that it is locked into place. So yeah, that's kind of what we're looking at right now. But if I do switch over to the 10-minute time frame, we can see that we are clearly above that green box, getting up to around 40. And I actually talked about that like a week ago, that I thought it might be going that high, but it seemed like we were topping on Friday. So that's unfortunate. And I see Sean there. The market is in free fall. People are freaking out. I have a bunch of money on the sidelines, and I am ready. No big deal for me. Yeah, I think that's the way to play it. Money on the sidelines right now. I wish I would have done that last week with Neo, taken some out at break even or slightly above average, but didn't do that. So, I'm just chilling. And so, yeah, the UVIX here suggesting free fall with it approaching 40. We'll have to see where it opens up at. But yeah, I think in times like this, it's good to keep cool, whether you got cash on the side or not. Good to see where it bottoms, and there's, the reality that you can never time the exact bottom or top. You can never get it in that exact range. And so with stuff free falling right now, with the UVIX shooting up, you're not going to be able to time it exactly. You're not going to be able to get the exact level. So good to just kind of chill, wait for that bottom to form, for there to be some signs that it's in. Right now with the UVIX, we don't see that. We're not seeing that. This green box that I have drawn here, I'm going to have to, actually, I'll just do it now. I'm going to raise it up to 40, because I think that's probably the reality, that is that we're going to be going up to that line, if not even higher. Actually, maybe, saying we're probably going to be going up to that line and drawing at 70 cents short. That's not very fair. So I am just going to adjust these. So yeah, getting up to that blue line, effectively that purple downtrend at 40.70. So yeah, good to be ready for further downside in the market. But then here, looking at the UVIX, let's switch over to the VIX. This one did pierce this level I have marked here at 23.76. That was the high from over here. Not really sure if that's too significant, but we did get, a couple fake out tests of that. And then, when we were over here, so maybe this is good to be cautious about being super bearish now, or with the VIX or UVIX going long, is that the last time we pierced this level, I'll do a yellow line in the sand, or maybe I'll do orange. That is, a level that we did pierce, closed actually above this 236. And what's that from? That is from this big retracement, but to the downside over there. Yeah, we did not reside above these levels for very long. VIX did close yesterday above 20, well above 20, closing at 22.78, being up 16% on the day. So yeah, pretty crazy. And so yeah, like I don't trade the VIX, I do trade the UVIX. Currently don't have a position in it, unfortunately. But yeah, I mean, just 17% here yesterday, 16% with the VIX. Very nice way to, capitalize on this volatility. I wish I was heavier in it or had a position in either of these, but unfortunately don't. That's the reality. But yeah, piercing that level, did not close above 23.76. So we'll see it. Maybe we do something. It looks like I think we're going to be gapping up, but then maybe we could do something like that, whether that's to the upside or the downside. Who knows? But yeah, it looks like good to be pretty cautious. And yeah, but also, I mean, if there are certain stocks that you like a lot, probably good to, I covered natural gas going short it a little bit, and I just had an order filled buying the dip on KOLD at 1969, just one share though, nothing too crazy. So yeah, it doesn't look like we're doing that. Arrow does look like we're above this uptrend here, so we'll have to see. I think that the reality is that's been a notable level in the past. I think the reality is we do kind of do something like that. And so I'm not going to draw that as an arrow because I don't know which way it would go. But yeah, see that as support over here. With resistance over here now above it, going to be support again. But yeah, let's switch over to the 10-minute time frame. And yeah, it looks like it's did get rejected from that 23.76. Saw one close above it and then quickly came back down 10 minutes later. So, yep, I think 23.76, notable level around $24. So good to keep that in mind. But then let's switch over to first the daily time frame, and then I'm going to switch over to the SPY. This is the S&P 500 tracking ETF, which closed yesterday at a price of $583.77, being down 1.75%, and it looks like it's continuing down about 0.69% in the pre-market. And yeah, I mean, this actually I think is kind of neat. We're still, effectively respecting this 786. We are trading below it. That's around 583.50. We're trading below 580 currently, and yesterday's low was 579.90. That's effectively where we're at right now, around yesterday's low. But, we could still be respecting this down. I mean, it is downtrend, but it could still be acting as support along with the 786 as long as we're not getting closes below it. We did close about, 30 cents above it, 31 cents above it yesterday. Not that those pennies really matter, though. It's just an approximate level. But if we do take a step back, not as big of a step back as that we were just looking, but yeah, we got this parallel channel based on those 3 pivot points there. Did test the base of that multiple times, got kind of a fake out break below it. I wonder if we could be getting another test. Man, I had this drawn like yesterday, I think on the SPX. I had circled it, and I think that we are going to be potentially going down to 575. Full retracement, finding not only that yellow downtrend as support, but also that light blue one. So do keep that in mind. I don't think that this is going to be happening. Whenever I get really excited, really bullish or bearish one way or the other, the opposite tends to happen. But with what we're seeing here, I could see it do something like that, and then maybe that, and then by that time, this over here would potentially be coinciding with this downtrend. Get a little bit of a rejection and then a break above, retest, something like that. So yeah, there might be some more pain over the course of, I mean, this is really like the next month, so hopefully it doesn't take that long, but we will see. And man, BBAI has dipped to 450. Anyways, let's flip over to the 10-minute time frame. And we are, over here, hitting a lower low in the pre-market than we hit yesterday during market hours, hitting a low of $579.49. A little bit above that right now, but it's below 580, so we will have to see. Maybe this is a gap down opportunity. If it does gap down into the market open, maybe we bounce. Maybe there's some good news that follows, so who knows. But yeah, looking at this, let's just quickly look over at the SPX, which is the S&P 500 index. Closed yesterday at a price of $5,849.72, being down 1.76% on the day. Again, I don't think this is going to happen, and that we are probably, I should have left the circle up there. It does look like we are probably going to head down to around $5,773. So do look for that, but maybe we do find support again around the 786. Does look like this purple line was a good kind of dip buy level with some fake out breaks below it, but got some nice bounces. So maybe we see some more fake out breakdowns coming down to around, like I said, $5,773.31 being the low from January 13th. If we do flip over to the 10-minute time frame, nothing going on in the pre-market because the SPX does not trade in the pre-market. But maybe we're forming some lower lows here, maybe forming a little bit of a parallel channel. And so maybe I can draw that. I will delete it. So kind of like following this break here, a little bit of a parallel channel there. Maybe I want to adjust this to over here, and then got a little bit of a fake out break above. We are kind of testing the base of that. But yeah, I mean, I could just move that around to it to get it to, be exactly where I like it. But it's from over here. I mean, I could, let's see, maybe I actually want to do this in the opposite way based on bottom pivot points. And so it does look like we got kind of a nice test of it over here, and then just top over here. And so, yeah, I mean, kind of danced around it, danced around the top. Maybe I can move it like this. Maybe that looks a little bit better. I don't know. But it does suggest that we could be seeing some lower moves. But anyways, yeah, in a downtrend, that kind of sucks. But good to be able to take advantage of dips if you're prepared for that. If not, good to just chill, sit on hands. That's what I'm trying to do. But anyways, now we're looking at the SPX. Let's flip over to Bitcoin. Pretty crazy here. Close or trading around 83,000. I do have this purple line marked at 83,000, so that's kind of neat. We did break below 86. Do have an alert there. I'm not buying the dip, doing anything crazy like that, just doing my normal $5 DCAs. And to be honest, I'm glad that this is still at a discount. I think we're still going to be hitting new all-time highs of Bitcoin between May and the end of December. So I'm not sweating it too much. Glad to still be stacking. Although, it is unfortunate we are below some of these levels, 86 I had just mentioned. I was thinking we were going to be pulling down, hanging out around 86, finding some support around that yellow downtrend. Does not look like that's happening. We are fake out breaking lower, or maybe it's not a fake out break down lower, because the big green candle that we saw a couple days ago has been completely retraced. Trading, like I said, around 83,000. But maybe we can get a bounce to reclaim 86 or this downtrend here, which is around 87. So I'd look for today's close around there. Webull does not have the best closes because I think this is on East Coast time. Best to look at Bitcoin in GMT, UTC, Zulu, other ways to phrase it. But yeah, I think that's the best time zone to consider when looking at Bitcoin. And yeah, we do have this very notable downtrend, which I did extend, and we beautifully got rejected from that. That white downtrend coinciding with this red uptrend. And so, I think that right around the 92, really getting into the 90s up to around 95,000, there's going to be a lot of resistance there. So good to be cautious of that. And yeah, I think that for me personally, I do my normal $5 DCAs, daily DCAs, so nothing too crazy. I'm a small fish. I do have alerts down here at 75, 72, and 69. I think they have 3 buy orders placed, but it might just be 75 and 72,000 for $10 dip buy, just being a little bit more aggressive than my daily DCA of 5. But my plan, my strategy is if it does come down to 69,000, I am just going to, kind of say, hey, this is an opportunity that I think will be well rewarded later in the year. So I might take a little bit from effectively my savings, which is really just future bills set aside. And by future, I mean like months and months into the future. I might take some of that out to buy the dip at 69,000 if it does go down there, but I don't think it's going to. I think too many people expect it to get into the shaded box, and I don't even think that 75 or 72 is going to get filled, but if they do, I'll be happy about that. I think that's good to be prepared for that. And we got about 10 minutes before the Plug Power earnings call starts. So before we get into that, I will check out the comments in a second. Did just want to go over ticker symbol URA, which is the Global X Uranium ETF. This, I think is just a really nice example of why it's good to be patient. Closed yesterday at 23.49, being down 5.28% on the day in the pre-market. It's even lower, down more than 1% in the pre-market, around 23.19. And yeah, I had talked about, I thought that this purple line, this purple doodle would happen coming down to around 24.50. We're down more than $1 lower than that currently. And so, yeah, I think it's good to take advantage of the discounts. I think it's good to be taking advantage of the, the sale. But I think it's also good to be patient. One thing that I could do is, I got this nice little light blue Fibonacci retracement there. We are trading below the 786 at 24.50, also trading below this white uptrend. But what I can do is I can draw another array going from that low of 22.18, but then connect it to the low over here, which was at a price of 22.29. So I'm just going to adjust that to be marking those levels. And so, yeah, that's based on the lows rather than the close. Kind of rhymes. And so I think that's going to be like a, hey, look at that. Maybe I want to, these greens, I don't like the greens because they're just kind of like, they look too similar to that light blue. But anyways, this is a white line, not a blue line. And that was based on the low from over here from August 5th. And then the close from September 6th, so that green one that I just drew is based on the low, not the close, from September 6th. And we are actually still above that. So I'm wondering if that is the dip buy level that we want to be looking at. And so for me personally, I am not trading URA. I do have a small position, I believe just 2 shares of OKLO, ticker symbol OKLO. And yeah, I still think that this could be happening, but maybe it's just going to be like that. So yeah, that would be coming down to around 23. So maybe I want to put an alert at actually, because we blew past 24.50. I'm just going to adjust the alerts that I already have. I'm going to do below 23, that would be like, hey, maybe the bottom's in, maybe I want to add to my Oklo position, and then I meant to change this to above for 25. That would be suggesting, hey, we're getting some strength, we're getting back above these levels. Then, the bottom may very well have been in whether we hit 23 or not. And, then we start to see these moves to, fill this gap, get to that yellow downtrend based on the highs from over here, stuff like that. So, yeah, let's just look at the 10-minute time frame. And we are, testing around the doodle that I have drawn there, but we have 23. I thought that we'd be able to see that green uptrend that I had drawn, but that's not showing up here. So, yeah, 23.16 is the low in the pre-market, so kind of in free fall there. But yeah, we'll have to see. And so I'm just going to put this on the plug power chart, which, I think I had added maybe 5 or 10 shares at like at 160, and then it's like, okay, I'm just pumping the brakes. The low from yesterday was $1.45 in the pre-market. It looks like we are seeing this free falling around 135. Plug Power shares drop pre-market after annual loss, further cost-cutting plans. And so, yeah, I think that unfortunately Plug Power, along with ChargePoint, I think that they're just kind of like too speculative for the market right now. But I think that the discounts that we're seeing, there could be opportunities to trim, get out at break even or at some profits later. But yeah, free fall. Good to be having the brakes on. And so Sean followed up with his comment. I use the 1 month candle with a 50 and 100 and 200 day moving averages. It allows me to be patient with individual stocks and ETFs. I think it's a really good strategy. I don't tend to look at the monthly very often, occasionally look at the weekly. The moving averages that I use, which thanks for the reminder, I don't have them up there. 21 day, 50 and 200 day, but looking at the 10 minute, that's just 201, 210 minute, 500 minute, and 2000 minute, looking at the 10 minute time frame based on those candles. But yeah, 134 now. And then Ardij, I'm not sure if I'm pronouncing it right, saying hello, how's it going? And so what I might do now, as we've got about 5 minutes before their earnings call starts, and then so I will be taking notes on the call, largely just for doing timestamps later. And then, I might be looking at my phone a little bit just because, so much volatility in the market, just seeing what's going on. And I personally just have Neo up here because, I have some calls in that, and I could have gotten out at break even or actually taken some profit. Last week I didn't, which is stupid. But, it is what it is. I got months before they expire, so not really too concerned. But anyways, enough about that stuff. And I will just get us connected to the Plug Power earnings call and make sure that audio is connected and that we are all set. Maybe I just want to check anything that's going on. So yeah, people talking about AMC. I'm not going to get into all the stuff there. No notifications on news, so let's go over to the Plug Power event and what I might do. Let's see. I'll come back to this in a second. But news and events, so it's not listed here. February 26th. Okay, so investor resources. Maybe I want to go to that. Analyst coverage. So I probably want to go to press releases. So March 3rd, Plug Power adopts. And so this is what I want to go to. This is the information that I have. So I am probably just going to copy this and put this into the, let's see, the over here. So I will put that, I'll put it above my links. Actually, no. I'll do it. Sorry, I'm a little indecisive. I'm tired. I haven't had any coffee. I made coffee. It's sitting right in front of me, but I haven't made it. So yeah, I'll save that. And then just going to make sure that's all good. And okay, cool. So over here, so you got a link to this. I'm going to connect to here. And so I'm just going to let's see. I want to have Chrome viewable, but I'm going to remove my display so you can't see all of my info as I enter it. And let's see. Got to enter the DGen Ed company name. Submit that. Okay, and so the volume is muted for you guys. And I will connect myself to the audio, so when the music stops, which should be in about 2 minutes, the earnings call will start, and then we can enjoy listening to their call as the stock continues to go lower. And yeah, and the reason why I have it, something's going on. Still just music. Since I've entered the info, I can reveal what I've been looking at. Yep, so this is that, and yeah, so let's see. 134 is still the low in the pre-market. Everything's free falling. Good to keep it cool. And so, yeah. So this is pretty exciting, and I might do a follow-up post over here. And that's this one, so this guy's a good person to follow. Anybody can pick stocks. Knowing how the game is played is what gives you the edge. Learn, because that's how you get ahead, and stay there. Good to keep it cool. Over here, just music. It is 8:30, but it has not started. I'm just going to refresh this page in case. Okay. I am starting. Sounds like a...
Quarter 2020.
Let me know if it's too loud, too quiet. If it is, maybe just adjust it on yours first, and then I will try to adjust it here. I'll turn my mic off so we can listen.
If anyone should require operator assistance, please press *0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce Teal Horace, Vice President, Marketing and Communications. Thank you. You may begin.
Thank you. Welcome to the 2024 fourth quarter and year-end earnings call. This call will include forward-looking statements. These forward-looking statements contain projections of our future results of operations or a financial position or other forward-looking information. We intend these forward-looking statements to be covered by the safe harbor provisions for forward-looking statements contained in Section 27A of the Securities Act of 1933 and Section 21E of the Securities Exchange Act of 1934. We believe that it is important to communicate our future expectations to investors. However, investors are cautioned not to unduly rely on forward-looking statements, and such statements should not be read or understood as a guarantee of future performance or results. Such statements are subject to risks and uncertainties that could cause actual results or performance to differ materially from those discussed as a result of various factors, including but not limited to risks and uncertainties discussed under Item 1A Risk Factors in our annual report on Form 10-K for the fiscal year ending December 31st, 2024, as well as other reports we file from time to time with the SEC. These forward-looking statements speak only as of the day in which the statements are made, and we do not undertake or intend to update any forward-looking statements after this call or as a result of new information. At this point, I would like to turn the call over to Plug Power CEO, Andy Marsh.
Good morning, and thank you for joining our fourth quarter conference call. Last night, we announced significant structural change to streamline our cost base through Project Quantum Leap. Over the coming months, we'll be reducing staff, refining our product focus, and consolidating facilities. These measures are targeted to generate annualized cost savings of $150 to $200 million. These decisions are not easy, but they are necessary. The slower than anticipated development of the hydrogen market has been influenced by multiple factors, including the pace of policy implementation, global energy insecurity driven by geopolitical conflicts, the higher cost of project execution, and passed-over enthusiasm in the sector. However, we remain confident that hydrogen will play a critical role in the future energy mix, with many experts projecting it will eventually contribute 10 to 20% of the world's energy supplies. The projects that will progress the fastest are those with a clear value proposition, strong policy support, and a well-integrated value chain. As we assess our businesses, our primary focus moving forward will be on three key areas: material handling, electrolyzers, and hydrogen generation to support material handling, as they align best with these attributes. In material handling, we deliver a compelling value proposition by helping customers move goods more efficiently. Plug benefits from three revenue streams in this business: products, services, and hydrogen. In 2024, we have made significant improvements in improving margins for service and hydrogen, expanding them by approximately $120 million compared to 2023, excluding the impact of customer warrant charges. Product margins, however, are tied to sales and factory utilization. Last year, sales were slower as we worked through price renegotiations with major customers and the transition from PPA to direct sales. That process is now complete, and we expect increased deployments this year from both existing and new customers, which will improve our facility utilization and drive positive gross margin. Additionally, hydrogen margins will continue improving with the launch of our new joint venture facility in Louisiana this month, while service is on track to reach profitability by year's end. Hydrogen production costs are a critical driver of both our profitability and the broader market development for fuel cells. By the end of this month, Plug will have 39 tons per day of capacity, while customer demand stands at approximately 55 tons per day. The DOE approval for our limestone plant in Texas, a project creating jobs in a deeply conservative district, was secured in January. We've already have the necessary equipment to cover our equity investment in the project and are finalizing discussions with an external investors to complete the funding structure. Given the change in administration, we now anticipate a later start in 2025, with project completion expected 18 to 24 months from the start date. Importantly, we do not plan to contribute additional Plug equity to complete the project and anticipate retaining a 70 to 80% ownership stake once operational. Our electrolyzer business is essential to both our near-term and long-term growth. The primary applications involve replacing gray hydrogen in sectors like refining, green ammonia, and methanol production. Global demand remains strong, and we expect significant growth in both sales and bookings this year. Notably, we're executing large-scale projects, including the 100-megawatt deployment with Galp. Here's why I see, and this is really important, here's why I see tremendous potential in this market for Plug. Unlike some hydrogen fuel cell market that face challenges across the value chain, such as infrastructure, fueling, and financing hurdles for on-road vehicles, the replacement of gray hydrogen with green hydrogen is a much simpler transition. Customers can blend green hydrogen into existing processes without major operational changes, which accelerates deployments, speeds up time to markets, and you deliver immediate benefits. As we move forward from this restructuring and market adjustments, Plug will prioritize material handling, hydrogen production supporting material handling, and electrolyzer sales, alongside profitable cash-generating assets in well-established markets. If the program is not tied to profitability or cash generation, Plug will not pursue the program in the near or long term. With that, I'd like to turn the call over to Sanjay to review our Q4 results, followed by Paul, who will provide insights into our financial outlook.
Thank you, Andy, and good morning, everyone. 2024 was a year of recalibration for Plug. It included some successes and some challenges. On a positive front, fourth quarter of 2024 marked another quarter of meaningful reduction in cash burn, continued gross margin expansion, and another step change in growth of our electrolyzer business. Cash burn for the quarter was down over 70% year over year, and gross profit improved year over year when you exclude the non-cash charges of customer warrant and inventory adjustment. It is important to highlight that this margin expansion was accomplished despite lower revenue year over year. Now, in terms of challenges, market growth, as Andy touched on it, has been slower than anticipated. Reported revenue for Q4 24 came in at $191 million and full-year revenue of $629 million. We are disappointed with this continued slippage of revenue, despite significant improvement in sales of the electrolyzer business. We believe it is important to highlight a few key items that negatively impacted revenue in the quarter and for the full year 2024. As we highlighted in our press release issued last night, our application business revenue was impacted by a higher than usual warrant charge of $22.7 million, and we had another $8 million in revenue that got pushed out related to a specific customer program in our material handling business. In our cryogenic tanker and trailer business, we actually made a strategic decision not to ship multiple mobile refueler product to a customer in Class 8 truck space, given their financial position, which negatively impacted revenue by about $16 million in the quarter. In addition, we also had some production delays on few key product line in our cryogenic business that had an impact of about $12 million of revenue in the quarter. Just to reconfirm, this production impact has been already mitigated and will show up as revenue in the first half of 2025. Despite delivering almost six-fold revenue growth in the fourth quarter of 2024 versus fourth quarter of 2023, our electrolyzer business in the fourth quarter was negatively impacted by multiple factors, which represented revenue impact of as much as $68 million. We expect some of this revenue to materialize in Q1 of 2025. Majority of this is related to customer delays, site readiness, with some of the projects actually getting pushed to Q2 and Q3 of this year. And frankly, this revenue fluctuation on a quarterly basis, in our opinion, reflects the early stage of the industry growth, as both supplier and customers learn to work together and keep moving projects forward. These factors had a total impact of over $120 million of revenue in Q4 of 2024. Just to reiterate, we believe some of the electrolyzer opportunity will contribute to revenue in Q1 25, and majority of the customer push-out will be revenue opportunities in Q2 and Q3 of this year. Production-related delays in our cryogenic business have already been addressed and will contribute to revenue opportunity in the first half of 2025. We also expect the revenue push-out from Q4 24 in our material handling business to contribute to revenue in Q1 of 2025. Based on all these items that impacted Q4 24, overall seasonality in the first half of our business, and overall macro environment, we believe our Q1 25 revenue will be in the range of $125 to $140 million. You should expect to see continued gross margin improvement. We believe the year of 2025 is set up to be a year of meaningful bookings in our electrolyzer business. As Andy highlighted, Given the current macro environment, we remain focused on driving costs down, expanding margin, and reducing our cash burn. With that, let me turn the call over to Paul to discuss the financial outlook in some more detail.
Thank you, Sanjay. Since Andy addressed some of the broader market issues and Sanjay talked about revenues and margins for the quarter, let me jump into a few specific topics. As conveyed in our filings yesterday, Plug recorded non-cash charges in the quarter of approximately $971 million for asset impairments and bad debt and OpEx, and approximately $104 million in COGS for inventory valuation adjustments. These stem from multiple factors, including the decision to temper focus on certain products and markets that are more midterm opportunities, and overall market conditions resulting in slower growth of the industry than anticipated. In terms of the impairments, this relates to property, plant, and equipment, intangible assets, non-marketable equity investments, and assets associated with power purchase agreements and fuel. As a result of these impairments, it will reduce future amortization and depreciation, including a reduction of $55 to $60 million in 2025. In regard to cash burn, we were laser focused on margin and cash flow improvement in 2024, and we saw benefits throughout the year, and in particular in Q4 24. These actions included targeted price increases, labor optimization, rooftop consolidations, improvement in production costs, and leveraging our hydrogen platform with our new green hydrogen plant in Georgia coming online. We expect in 25 to include a full year of benefits from these activities undertaken during 24. In addition, we expect initiatives and Project Quantum Leap to provide meaningful incremental improvement in margins and cash flows, starting in Q2 of 2025 and building throughout the year. These additional measures will be complemented with the strategic efforts such as our new hydrogen Louisiana plant coming online in Q2 of 2025. We continue to be laser focused on driving to positive margins and cash flows in the near term. In terms of liquidity, we ended 2024 with more cash on hand than we anticipated, with over $200 million in unrestricted cash. We recently closed our first ITC transfer sale for the $30 million benefit associated with the liquefier at our Georgia green hydrogen plant, illustrating opportunities to leverage additional ITC assets. We have an effectively unleveraged balance sheet, and we are currently working with existing partners on varied capital solutions. These factors, coupled with the focus on improvement in margins and cash flows, put us in a strong position to achieve our near and midterm financial goals and fund the company with the most prudent, cost-efficient capital solutions. I'll now turn it back over to Andy.
Okay, I guess opening for Q&A, Teal.
Thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star one on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star two to remove yourself from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for your questions. Our first questions come from the line of Colin Rusch with Oppenheimer. Please proceed with your questions.
Thanks so much, guys. Can you talk about, the maturity of the financing for a number of the projects that you're talking about in that pipeline? The project financing oftentimes is a key gatekeeper, but just want to get a sense of cash flow supporting all of those projects at this point.
So why don't you take that, Sanjay?
So Colin, are you referring to some of the opportunities on
the electrolyzer?
Yeah.
Yep, exactly, on the electrolyzers.
Sure. So, again, we are looking at two very large projects here in the near term. One is in Europe and one is in North America. And the project in Europe actually is going to final investment decision here by the end of the quarter. And, look, it's a fully funded project, right, backed by a very large financial institution. So financing and the opportunity set of this project should not be a challenge. And next project in North America is actually related to big methanol opportunity. Again, there is already an offtake for that methanol opportunity. So in light of that, Colin, the biggest thing in this space, right, is before you get to FID, you got to secure that offtake, really get the financing structure looking a lot like solar and wind from an offtake standpoint. Both of the projects that we're looking at here in the first half of the year have that attribute. So we're really not concerned from an overall financing standpoint. We just want to make sure that we land the project. We've already done the basic engineering design package in these cases, and looking forward to, moving ahead with the customer.
Thanks so much. And then, on the material handling side, obviously there was, a lull in some of the spending in warehouse automation and, some of the capacity getting digested in the warehouse space. Can you talk a little bit about what you're seeing from early indications? We saw some green shoots late in 24 on folks starting to spend again, but any material change in some of the spending patterns that you guys are seeing with some of those customers?
I think I'll give you one indicator, Colin, is that one of my largest customers put down money to be able to qualify under the old 48 to support $200 million worth of business. I think that's, a strong statement about their anticipated growth and expansion. We have both, what we see, and we announced, as you may remember, in the fourth quarter, expansion with BMW in Germany, just to name a few of the larger customers. I can tell you that this announcement last night helps us with our customers. I checked in with some of our sales folks who I asked to reach out after market close to let them know what we were planning to do. What I heard was, we're happy you're going to take the steps to reach profitability. We're glad you're focusing on our segment, and it makes it easier to do business in the future. So, it's these are very, very difficult decisions, but in the material handling market, we expect that this will be well received. I mean, if you take a look back, Colin, I mean, I was just sitting here thinking about, Paul mentioned when you start thinking about the income statement level, depreciation was going to reduce $60 million. We're reducing our annualized cost between $150 to $200 million. They're big steps to reaching profitability.
Super helpful, guys. Appreciate it.
Okay.
Thank you. Our next questions come from the line of Craig Irwin with Roth Capital Partners. Please proceed with your questions.
Thank you for taking my questions. So, Andy, I wanted to ask about the DOE, right? Your loan package with the DOE. There's a lot of investor skepticism out there, and nobody's going to know but you guys about what's actually being discussed with DOE and what the changes are. Can you maybe share with us any content of communications with DOE over the last few weeks? Do you expect this team to continue to support the loan package the way it was written? Are there any changes or updates that you might want to share with us around the loan package that would help investors understand the opportunity?
Yep. Craig, there has been discussions with the DOE, and we're pleased at a working level. The individuals we have been dealing with have remained at the DOE. So we're not going through the process of re-educating the team. I think that's a big positive. I know there's lots of noise, but I can tell you when I became CEO of Plug, the first thing I did was step back and try to figure out everything that was going on. We have had regular conversations with the DOE over the past month. I personally will be spending time with them this week. So, from an engagement point of view, and look, we're in very, very red districts. We're in Texas where we're looking to build this. And I can tell you the local political teams, political folks in that region are strong supporters of this and are reaching out to make sure that this loan is executed on, executed on the deal that we came to. Look, obviously things which are associated with more social-oriented issues will be downplayed. During the call, I mentioned, during the opening statement, Craig, I mentioned how, our portion of the equity we already have with equipment We do have, a few funds who want to play side by side with us. I would expect, that construction of this project will most likely happen in the fourth quarter, and that you can say 18 to 24 months before it's completed. And I know you didn't ask this question, but I do want to highlight. We learned a lot from building Georgia how to build a plant, and I can tell you the Louisiana build was much, much simpler. We actually have learned a lot, and I think the learnings we have, as well as the cost reductions it'll bring to the business, will be really beneficial long term.
Excellent, excellent. Then, you touched on this in your response, and it was going to be my second question. So, outside investors for the Texas project, you've already obviously attracted some pretty interesting attention and orders from groups like Fortescue for their Gibson Island project. Can you maybe frame out for us the character of outside investors that are possible there? I know there's some global funds that are pretty active in evaluating this opportunity, that really want the opportunity to invest in hydrogen. But are we looking more at private equity or other institutional investors as probable partners on the Texas project?
We are looking at, and Sanjay and Paul jump in, I would define most of the folks looking at are infrastructure funds looking to invest. And look, they're looking to invest in a new segment where there's growth potential. And, we have a process that's going on. We've identified 2 or 3 folks that we've been talking to. And, I think that, I think you'll be hearing more about it during the coming months. And look, I think your first question, Craig, is important to this discussion. Look, people want clarity, what's going on with the DOE, and that's part of the process in making sure that we can close these funds, close with these funds in a timely fashion.
Thank you for that, Andy, and congratulations on the strong progress. With your cash use, it's really pretty dramatic, the changes in this last year.
Yeah, thank you, Craig, and we're going to continue to drive more to make sure we have a strong financial position.
Thank you. Our next questions come from the line of Samia Jain with UBS. Please proceed with your questions.
Hey guys, good morning. So how are you looking at data center backup power generation, and how do you see Plug benefiting from that in 2025?
To be direct, I don't see it as a benefit in 2025. Our view is that when it comes to hydrogen, one of the biggest challenges is to make sure that you can support long duration outages, and that requires a great deal of hydrogen storage on site. We think that business opportunity is a 28, 29 opportunity. Really, to be successful, we really think you need hydrogen pipelines that you can store hydrogen in, and there are some data centers in Europe that could make sense in the future, but I would not expect revenue from that segment of any size over the next 2 to 3 years.
Got it. Thank you.
Thank you. Our next questions come from the line of Bill Peterson with J.P. Morgan. Please proceed with your questions.
Yeah, hi. Good morning, Paul and Andy and team. I want to maybe take the applications question more broader than just the high power stationary. So I think at the symposium a few months ago, I guess you thought that the materials handling should probably go to 20 to 30% year-on-year growth. And now you're kind of expecting 10 to 20%. More broadly, I guess, over the next few years, what is going to drive the applications business? Is it going to be materials handling at this stage, given your comments around stationary power, not, or at least the high power backup, and maybe not viable in the next few years. And then mobility appears to be fairly challenged as well. So what's going to drive the applications business, and what's the right way to think about the growth over the next few years?
Bill, this is a real important question. I kind of touched on in my remarks, but the material handling business, you have a plug established, what I'll call a micro infrastructure that can support the customer's needs, and so the value chain is clear. And you look at markets like on-road mobility and stationary, there's so many other items in the value chain that have to be implemented and be successful for those businesses to grow fast over the coming 2 to 3 years. So, material handling is one that we can look at and say the pieces are in place. It's also, and you may have heard in my comments, when I talk about the electrolyzer market, it's not going to be folks who are going to dominate, who are looking to drive mobility. It is going to be people who are able to put the end product, whether hydrogen or green ammonia or methanol or SAF, directly into the value chain without too much complication. I mean, I sat through about 3-4 months, I sat through a McKinsey presentation in D.C., and I sat back and listened to it and said to myself, they had a matrix of how one should think about markets, though they weren't talking about hydrogen specifically, they were talking about the whole renewable world. And it really was kind of a clarifier to me that you need to develop focus on value chain. And look, our business will grow as we improve. If you're a customer, what's your biggest concern when it comes to plug? You have a business that improves the productivity of your operation. You have a company that, we have fixed the hydrogen issues and risks our customers may have. The biggest risk is, how will plug perform financially? And the steps we've taken today will actually help us accelerate growth in the market. And I can tell you, I do know of some of our large customers, they're looking to accelerate their growth. If our numbers are lower today, Bill, look, we don't want to overpromise. We want to make sure we deliver, and so we want to set clear expectations. But I think we see a healthy market, and it's why we're laser focused on material handling and why we're going to be laser focused on electrolyzers.
Thank you. Our next questions come from the line of Eric Stine with Craig-Hallum. Please proceed with your.
Good morning, everyone.
Morning, Eric.
Hey, so I can appreciate it. Sounds like not guiding to fiscal 25, and I know, Sanjay, you gave Q1, but maybe just some commentary on the year. I mean, should we expect this to be your typical mix, first half versus second half? How do you expect the year to play out sequentially? Any details to fill that in would be helpful.
That's right, Eric. Look, I mean, as I kind of touched on it, so Q1 you have seasonality, right? Then we are looking at sort of the macro environment that's got a lot of puts and takes, if you would. And there is a benefit, however, though, of some push-outs from Q4 into Q1. So when you look at this $125 to $140 million in sales, typically Q1 has been 10 to 15%, but given some of the push-out, you can probably imagine it's more like 15% plus in terms of the revenue mix, 15 to 20%. So in light of that, that's, I think, how you should think about the full year for the company at this point in time. And one another thing, we just want to make sure that Andy touched on it. What we have the strongest visibility on is Q1, We're already obviously sitting here in the month of March. We will do the same thing when we report our Q1 earnings to give you the visibility on Q2. We're really focused on obviously driving that top line, getting the growth for the company in 25, but the bigger focus you can appreciate hopefully is on reducing cash burn, expanding margin, and really getting to that EBITDA break-even territory as soon as we can as a company.
Yeah, no, I totally get that, but those details are helpful. And then maybe a good segue just on the cost reductions in your plan here in 2025. I mean, you gave pretty good detail there. I'm just curious, how deep you see those. Is there more room to go if necessary? And how do you kind of balance that between, as you said, I mean, you've got, even though now you're going to be more focused, material handling, electrolyzers, hydrogen, still have a big growth opportunity. So how do you kind of balance your near-term objectives while still being able to execute on those longer-term growth plans?
So, Craig, I do believe that the learnings you receive from deploying projects actually have large benefits to other markets. Nothing makes us better at deploying electrolyzers than the fact that we learned how to build plants ourselves. Nothing helps us better for markets that will evolve in applications like stationary than getting our quality of our present fuel cell products better every day. So I think that some folk, I'm a power engineer by training, and I think a lot like a power engineer about how things scale. But when you think about fuel cells, you're really thinking about probably 2-3 different power levels of fuel cells, but learnings at one level translates to the next. So we're, look, we are making and focusing on activities that will make our financials stronger, which in the long run will really allow us to go into these other markets as they become available. So I guess that's, being successful now will help us a great deal in being successful in the future. And that's the decisions we're making.
Got it. And maybe I'll just sneak in one more. Just for the 150 to 200 million in targeted savings, can you just give kind of the high-level mix between cost of goods and OPEX?
I would say I'll take it quick, and Paul, correct me if you disagree. I would probably say that it's almost 50-50 between COGS and OPEX.
That's a good proxy.
Yeah. Look, we haven't made, we're obviously going through the process, and I have to be, respectful for our employees and others before I kind of say exact numbers.
Okay, thank you.
Thank you. Our next questions come from the line of George Gianarikas with Canaccord Genuity. Please proceed with your questions.
Hi, good morning, and thank you for taking my questions.
Good morning, George.
Good morning. I'd like to ask Andy about your view on the policy environment in Washington. It's clearly quite confusing, and I'm just curious as to whether you can share any details on conversations you've had or your view as to how the next 6 or 12 months will look. Thank you.
So, it's obviously an evolving environment, and I'm going to be spending some time in D.C. later this week. When I look at the history of fuel cells and hydrogen, the supporters of it, the last time we had a real major fuel cell only bill to support the industry actually happened under President Trump and a pure Republican Congress. I can tell you last week there was a bill introduced by Representative Tenney, who she's in a very, very red district supporting fuel cells, and it was her second bill that she introduced in this Congress. I think that, look, I've been pretty clear about the fact that we felt that the previous administration implementation of the IRA, especially when it came to hydrogen tax credits, was rather disappointing. And we kind of view the new administration as more business oriented, and hydrogen is actually supported strongly by the oil and gas industry, which is beneficial. I suspect there'll be ups and downs, but look, I think this is real important. There is a global market for green ammonia, green methanol. There's needs for hydrogen here in the United States for applications like ours. That's not going away. And this administration is looking for the U.S. to be, energy dominant. And to be energy dominant, you have to meet where the world sees demand and where the world sees new demand. And it is in SAF. It is in green ammonia. It is in green methanol. And that's not going to change. So I think it's really important for the U.S. To make sure that China doesn't dominate these industries long term. And I think many, many people in the House, in the Senate, as well as the DOE understand. Bergman, I think everybody knows, was one of the biggest proponents of the hydrogen hubs. I think I know this is a long answer, but I think it just needs to settle down.
Maybe as a follow-up, I'd love your thoughts also on what's happening in Europe too. Thank you.
There's, if I look at Europe, it's one of the reasons I think Sanjay is so positive about the electrolyzer market. So much of what we're working on, for example, is in the hydrogen hubs, Hydrogen Valley in Spain, where there's strong support for build-outs and deployments. I think that where you're going to see, and I think you're going to see Germany continue to support hydrogen deployments. Obviously, the geopolitical tensions at the moment, makes things a little tense. But look, even long term, we have a analyst who helps us in Europe, who was an ambassador to the EU, told us there could be huge opportunity for projects and deployments like we do in Ukraine once all this is calmed down. So, I think Europe is, there's certainly lots of nuances with Europe, but you can look at Spain and can see what's going on and say, hey, this is really good for Plug Power. I think you can say the same about Australia, and I think these are markets that are going to be the heart of our electrolyzer business. And look, you've heard our announcements in Portugal, for example, with Galp, what we're doing there, with what we're doing with Iberdrola in Spain. These are projects that are going in the ground now to support the economy, and all of them are supported by the governments at some level.
Thank you.
Thank you. As a reminder, if you would like to ask a question, please press star 1 on your telephone keypad. Our next questions come from the line of Sharif El-Maghrabi with BTIG. Please proceed with your questions.
Hey, good morning. Thanks for taking my question.
Good morning.
Good morning, Andy.
Yeah.
The Georgia ITC transfer is pretty interesting. Are there other piecemeal opportunities to pull cash out of existing equipment, either Georgia or elsewhere? And is there a reason you recognize the ITC on that particular liquefier rather than the entire plant?
Yeah,
Yes.
Andy wants me to answer that one, so this is Paul. The short answer on the first part is yes. We have, as an example, when we turn on our plant in Louisiana, there'll be a ITC credit there associated with the liquefier as well, that we can take and we'll share with our joint venture partner there. That could be, similar, size to what we recognized in Georgia. And then we have some additional assets that we've deployed last year for PPA opportunities that there's ITC benefits on that, is probably in the 15 to 20 million range that we're actually working pretty closely right now to closing in the near term on both of those opportunities. So that's meaningful and helpful, in terms of the cash. And then on the answer on Georgia is that, there's a decision to make on the balance of plant as to whether you take PTC or ITC. We've decided to take the PTC benefits. We've recognized those in our results last year, and, we're going to, continue to do that. Any plant that we put in place, we go through, a cash benefit analysis as to is it better to take the ITC or to do the PTC, and it's, there's many factors that fall into that, but that's the choice that we have. So that's where we stand on that, for the Georgia plant.
Thanks, Paul. I realized that was a two-parter, so thanks for taking my questions.
You're welcome.
Thank you. Our next questions come from the line of Chris Sung with Wolfe Research. Please proceed with your questions.
Hey, good morning, Andy, Sanjay, and Paul.
Morning,
just
Chris.
looking at your hey, Andy. Looking at your K, wanted to check, are there new conditions that you need to satisfy in order to receive the DOE loan?
I'm not sure. There's not new conditions. The loan was finalized in early January. The only thing that we have to do is, and it's approved. The way it works is the loan itself has been paper documented, approved. Everything's there. To apply the first project, which is Texas, there's some specific things that we have to put in place. In terms of like direct agreements between the DOE and the EPC contractors. An example is just one microcosm example. So those are things that we're working on. We're really close, and they're not necessarily additional conditions that make it any obstacles. It's just really, unfortunately, the parties that work on these things that we're working with have done many other deals with the DOE, so they're used to working with the DOE on these kind of ancillary agreements. And so it's more just, I would say, for lack of better words, the bureaucracy of just crossing the T's and dotting the I's and putting all those residual components in place to officially kick off Texas as a project underneath that structure.
Great, thanks, Paul. And just for my follow-up, on that loan, how much are you requesting as part of the first drawdown? And did you, sorry if I missed this earlier, did you say you're expecting proceeds in Q4, or is that when construction is expected to restart?
So we would, I would think that Q4 is my best estimate when construction would start. Paul, maybe you can go through the process of how you pull down cash.
Yeah, so the way it'll work is when we get the project approved and kick off the effort there, which is really getting the EPC guy going again, the EPC contractor going, which, as Andy said, tentatively would be, we're thinking would be probably in the fourth quarter. In the first month, what happens is you compile all of the anticipated invoices each month that you expect to pay as a part of that project, and you submit that to the DOE, and then they advance money against that. So that's, we're going to get credit for our equipment that we've contributed to the project, and then they will front money to pay the majority of the bills that we have to pay to construct that project as we move forward. So that's how practically it works.
Appreciate it. Thank you, guys. I'll turn it over.
Thanks, Chris.
Thank you. Our next questions come from the line of Tim Moore with Clear Street. Please proceed with your questions.
Thanks for taking my questions.
Good morning.
Good morning. An important watch point by investors is, the positive gross margin inflection point that investors have been, eagerly waiting on. You made some really good progress announcing the cost savings plan. I think your prior guidance at the symposium was, the expectation back then was to maybe be slightly positive gross margin exit rate for the year. I'm just wondering, now with the significant cost savings plans being rapidly implemented, do you think that exit rate still holds, or do you think you could pull it off in the third quarter for maybe positive third quarter gross margin?
I mean, Tim, our goal is always hopefully trying to do things sooner rather than later. But look, given everything and all puts and takes, I think it holds in terms of Q4 of 2025 as a good target that we are looking to turn gross margin positive.
Great, Sanjay. That's helpful. The other question I had is on a different topic. Maybe can you speak to maybe the liquid hydrogen appetite and the sentiment? The H2 hubs network rollout's a little bit behind schedule. Just, can you give any color or stories on, progress there with some customers and, green shoots for, takeaway from your production facilities?
Look, I think the hubs will develop. I never thought the hubs would develop that fast. If you looked at the funding for the hubs, it was years of study and implementation, and that was even under the previous administration. We never, and I think if you even go back to previous conference calls, we never expected significant near-term or even mid-term revenue from the hubs. I think hubs implementation would help the hydrogen industry later in this decade, and that's always been our view. And, they're just, I would say this, they never really had a very fast schedule, and I don't see them being meaningful to us over the next 2 to 3 years. But if implemented, not only is it a sales opportunity, but really helps to build out the larger hydrogen economy. So we're supportive, but probably are not stunned that they have not, accelerated as fast as people may have thought. But also, quite honestly, they're accelerating at a pace that the government actually laid out there. So that's kind of our thought process there.
Great, Andy. Thanks for that. And that's it for my questions.
All right.
Thank you. Our next questions come from the line of Samantha Ho with HSBC. Please proceed with your questions.
Hey, guys.
Morning, Samantha.
To bring it back to, hey, Andy. You mentioned a few times about the Texas plant being in a very red district that's very pro-hydrogen. And the one thing that's really striking me is just how much support the state of Texas has for hydrogen. Like, enthusiasm overall actually is quite palpable. Has there been any conversation in terms of Texas funding in any sort of stimulus or what type of initiatives that they can provide to get the industry, the hydrogen industry, really more competitive, or just accelerating all the developments there if the federal government does kind of pull back on their support?
I have not, I will be meeting with people from the Texas delegation this week. I have not seen anything, and we do have people in Houston. I have not seen anything to date. Where the Texas delegation can help us the most, and the Texas government, is to help move things through the DOE quicker as they learn. And I think you see both representatives and senators willing to help in that area.
Okay. I guess the other thing that I'm kind of curious about is with like potential monetization of the PTC. I realize that there's still a lot of questions as to what's going to happen with like a potential tax plan ultimately. But what sort of conversations are happening behind the scenes? In terms of opportunities to potentially monetize those once we have greater clarity. And then I guess what are your thoughts in terms of how quickly that could, like, what kind of milestones should we be looking at? Like, how quickly can anything on that side, occur?
You want to take that, Paul?
Yeah. So I guess there's two facets. One is practically the way it works is when you file your tax return, it's a direct pay associated with that. So worst case, we file in October, like other corporates that are calendar years, companies, and they pay from that. What we are working with is the tax equity broker that we used to close the ITC sale in Georgia to see if there's parties that want to discount that. It's only a few months, but it can be meaningful to us to discount and sell it off. The good news is we have, tax opinions from a reputable big global tax firm and all of the analysis and things that we need to put that package together and make it a very attractive opportunity to sell it off. So, and when we establish that, it makes it easier to do that for this year and start taking advantage of this year, monetizing this year's as well. So it's a work in process, and it's still new. Like any new market opportunity, it takes some time to kind of nurture through it. But we're pretty actually encouraged with the interest level and how we're postured to try and possibly monetize that.
Okay, thank you.
Thank you. Our next questions come from the line of Amit Dayal with H.C. Wainwright. Please proceed with your question.
Thank you. Good morning, everyone.
Good morning, Amit.
And hey, Andy. Just with respect to sort of the macro environment right now and how you're providing guidance, how much of the sales pipeline that was built, up until say 2024 is still valid? Can you give us a sense of how that aspect of the execution may have changed a little bit?
You want to take that, Sanjay?
Sure, happy to. Hey, Amit, how are you? Couple of things on this, right? So our electrolyzer business in 2025 largely is executing on the existing backlog. That really hasn't changed, right? We're hopeful that we might even be able to do slightly better than that, but it all really comes down to executing on the backlog. And just to put this in context, I mean, electrolyzer business grew about more than 60% year over year from 23 to 24. We wouldn't be surprised if it's a similar growth rate again in 2025. Now, another piece of our business, which is largely backlog driven as well, is our cryogenic tanker and trailer business. That business slowed down a bit year over year from 22 to 24, largely because of some of the push out, some decisions even we made on the mobile refueler space, even the collection situation and things like that. So that business, I think, again, will grow back up here in 2025 versus 2024 from a revenue standpoint. So short answer to your question, we really don't think there is any risk to that existing backlog. Obviously, we're going to want to book more business here. But one very important point to highlight here is we talk about potential for pretty big bookings in the electrolyzer business. Those bookings will really help 26 and beyond, not so much 2025, given the size of the project and when they move and things along those lines. But otherwise, we feel pretty good about the existing backlog. It's all about heads down and execute.
Thank you, Sanjay. My other questions have already been discussed. I'll take my other questions offline. Thank you.
Okay, thanks.
Thank you. Our next questions come from the line of Amit Thakkar with BMO Capital Markets. Please proceed with your questions.
Hi, good morning. Just one quick one for me. Given kind of your kind of path here to positive gross margins at the end of the year and the cost cutting, I was just wondering if you could kind of share with us what your plans are in terms of kind of relying on some of the facilities you have for external equity. How much is kind of baked into the year for that? Thanks.
So I would just say that we have not used any of that since mid-November. any of those facilities. And, they're there as a backdrop to support the business if required.
You have utilized the convertible facility, right, for I think it was 2 issuances of $22.5 million in, I think the first 2 months of the year. Is that separate from that?
Yeah, that's actually just payback. Instead of selling stock, we actually execute it by providing cash. Do you have anything else to comment, Paul?
Yeah, no, I think just for clarity, so we, the convertible that we did, the preferred convertible we did in November, there's been 2 elements. One is we had some amortization on that, and then because the stock price hit the 290, they did convert, I think it was 10 million shares. But to Andy's point, we have not used either of the ATM facility or the recent SEPA agreement with Yorkville. So, we sit in a good position with ending $200 million in cash, end of the year. And, things like the ITC help bring in liquidity. We also get the restricted cash at $50 million a quarter that comes in March. So there's a lot of positive things that are helping us navigate this fiscal year.
Thank you.
Thank you. Our next questions come from the line of Kashy Harrison with Piper Sandler. Please proceed with your questions.
Good morning, and thanks for taking the questions.
Good morning.
Good morning. So my first question is on Georgia. You've now had it running for around a year. Just curious where run rate utilization is on the project and how long it took to get there. And the same question for cost of goods sold. I think you guys were thinking about maybe $4-ish per kilo of production costs, but I'm just curious where actual results have landed relative to those expectations.
Do you want to take that one, Paul?
Yeah, I'd say, as you ramp and commission the plant, obviously the cost per kilogram is higher than what you expected. As we've gone through the year and really worked out the bugs and figured out how to run that plant more smoothly, you get the leverage on it, right? And so, I'd say we're kind of in that $5-ish kilogram range,
before the PTC.
Before the PTC, that's right. And obviously the PTC is super helpful.
Which gets it down to the 250 type range.
Exactly. So that's kind of where we're sitting at the moment, and we expect to take the full, this year will be really good because we'll get the full year benefit of that, whereas last year, you only got a portion of that because of the timing of turning on the plant and the periods of time that we were ramping up that facility.
Got it. And sorry, where is utilization?
Utilization is, we can run at full production. So, it's just based on demand. And so we need to run 15 tons a day. We will run 15 tons a day. I think most days are in the 11 to 12 tons per day range.
Got it. Helpful. And then my follow-up question is just thinking about just forward capacity. I think you talked about 39 tons per day of current capacity, current demand, I believe at 55. You're working on bringing Texas online, which is 45. So, you'll have excess capacity once Texas comes online. Just given all the comments around, the slower market development than you anticipated, just wondering where you're envisioning sending those excess volumes to. Thank you.
Not exactly wanting to provide information about who we're competing against and where we're looking to provide it. All I would say is we have a strong sales funnel and a strong sales team working those opportunities. There's big market already for liquid hydrogen, and we have opportunities with people who already buy liquid hydrogen at scale who are very, very interested in buying scale out of Texas.
Yeah, and Andy, maybe one more
Yeah,
thing.
go
right?
ahead.
As some of the players have decided they're exiting the green hydrogen space, as we bring some of these other plants online, and demand for green hydrogen is a long-term in nature, so that I think puts us in a pretty good position as well. Just to reiterate, as Andy said, look, we even have some discussion with existing industrial gas customers to do swap arrangement.
Yep.
It's all about if you have a plant in California, if you have a demand in the East Coast or in the Southeast, right, then that's where you end up doing a lot of swaps. So look, we work very closely together with many of them, and as Andy said, we feel pretty good about demand being there even as we bring our Texas plant online.
Got it. Thank you.
Thank you. Our next questions come from the line of Andrew Percoco with Morgan Stanley. Please proceed with your questions.
Great. Thanks for taking the question. Good morning, guys.
Good morning, Andrew.
Good morning, Andy. Maybe just to start out, coming back to the DOE loan for a second, I think in the press release you guys cited $400 million of coverage from the DOE loan on $600 million of incremental investment. I mean, that implies about, two-thirds coverage on an advance rate. I think you guys had previously talked about 80% advance rates on the DOE loan. So just curious what the delta is there and if there's been a change in maybe the advance rate assumptions that you're having on that facility.
Go ahead, Paul.
Yeah, there's no change. It's up to 80%, and the dynamics on each project will vary based on the size of the plant and other factors. And we also have some of that is a decent amount of contingency in those assumptions. And so, obviously with the learnings that we've had in Georgia and now Louisiana, we hope that feel like that we're in a pretty good position that we won't use all that. So that's the I guess the dynamic, Andrew, in terms of how it plays.
Okay, that's helpful context. And maybe just sticking with CapEx for a second, you quote $250 million that you've already spent on the project, another $600 million that you need to spend, gets you to about $850 million all in on a 45 ton per day plant. And if I just do that conversion, it implies like $19 to $20 million of CapEx per ton per day of production, which I think is actually a little bit higher than Georgia. So just curious, can you just maybe walk through some of your assumptions there? I guess I would have thought it would be lower than Georgia, just given some of the learnings that you guys have discussed. So any color there would be helpful. Thank you.
I don't know if the math is right, but Georgia will come in around $800 million with contingency, and the contingency is probably 10-15%, and so there's built-in contingency in that Texas number. So overall, I think before the contingency, it'll come in around $700 million.
Okay, thank you.
Okay, thanks, Andrew. And I think that's it for the day, Teal. Well, thank you everyone for joining the call. And look, we're making the tough decisions to make sure this business is successful long term. We're laser focused on material handling and hydrogen to support it, which will really help us grow the market long term. We're laser focused on electrolyzers, and especially those applications which can be deployed rapidly. We're making some tough decisions to cut costs and make sure the company can achieve our EBITDA and gross margin goals. So thank you everyone for joining. I appreciate the time. Bye now.
Thank you. This does conclude today's teleconference. We appreciate your participation. You may disconnect your lines at this time. Enjoy the rest of your day.
All right, so I'm just going to go over some of my thoughts, and I'm actually just going to record this as a video effectively, and then I'll, go over some stuff towards the end. So volume's off, I'm unplugged, and yeah, so I think it's nice that we're seeing a pop. I think that ultimately it's going to go lower, but I'm just going to go over that in what is going to be like a video. I'm just going to get out of what I have over here. All right, so, and I need to adjust my screen so you can see what I'm looking at and not just the Weeble chart. Okay, so I'm going to switch over to the daily and effectively just record a video that I will cut out of this as a clip, release it later so you can watch it if you like, if you need to get running to do stuff. And I'm going to do that based on the daily chart here. And I did adjust some of the levels, kind of refine them a little bit. And yeah, I might just make this one green over there. So yeah, I'll effectively just start recording this video. And I'm sitting up a little bit more, so there we go. All right, and so, hey, what's up? Welcome to DGen Ed. That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts and going over some data. And so here we're looking at Plug Power on the morning of Tuesday, March 4th. They just reported earnings, and we were just on the call, and now the market is open. Plug is currently trading around $1.50, being down about 1% from yesterday, but during the pre-market did hit a low of $1.34. And, you know, in all honesty, what I see happening with Plug, I've seen it before with ChargePoint, seen it with Luminar. When a stock does get to be, you know, close to $1 a share, tends to go down to $1 a share. We did hit the 52-week low this morning. It looks like so far the low is $1.37, being just 3 pennies above that low at $1.34. I suspect that Plug will be heading down to $1 a share, whether that's over the course of the next month, the rest of the year. I am not really sure, but I would be prepared for that $1 mark to be hit. And just so you know, the alerts that I do have marked up here, I do have one at $3 a share. I do think that it could be heading up to $3 a share, but that really was a level from over here that we did hit, so I don't necessarily know that that's going to happen. I also do have an alert for when we do cross above $1.50, which it does look like we hit above that level today. Then I also have an alert for $1.34, the pre-market low. And in all honesty, I do plan to add a little bit at that price. But if we do cross below $1.34, I will just be waiting for $1 a share. And yeah, I mean, I think that is probably the most likely scenario. And so there are a couple reasons why I think that. And yeah, I'm just going to switch over to some data so we can view that. And let's see, over here, I do have the Plug Power short interest. I just searched this on Google. And we can see that as of yesterday, March 3rd, Plug Power had, you know, a short float. The short percentage of the float that was short is around 32%, which is pretty high. Above 20%, that is considered to be pretty high. And then as of a month ago, it looks like we've increased that float short percentage by about 12%. And so that does mean that there is the possibility of a short squeeze. Maybe that's what we're seeing, you know, now as this does start to move higher, kind of getting a fake out break below this 160 level. And maybe we're going to see some price action moving up to around $2, maybe $3 a share. But I think that those shorts, you know, might be right. Like I said, I think that this could be going down to around, you know, $1 a share. If I do look at the max pain, we can see the numbers for the next few weeks. And we can see that for this Friday, March 7th, max pain is $2 a share. Currently trading well below that, around $1.50. So I don't think that we're going to be seeing, you know, any gamma squeezes or anything like that unless we are able to close well above $2 a share this Friday. And honestly, I don't really see that happening, but I, of course, could be wrong. The weeks following that, on Pi Day, March 14th, max pain is $1.50. So if we do start to get some momentum this week, and we do start to see a close next Friday on the 14th above $2 a share, I think that could then potentially trigger a gamma squeeze, and we see the stock price head up to maybe around $3 a share, which did act as kind of a top over here based on this Fibonacci retracement Fibonacci extension that I have drawn there, with the 100% move at 319 was a very good level to be taking some profits at. And then beyond that, we are just hanging out around $2 or $1.50 for max pains for the coming weeks. It isn't until June 20th when we see a max pain of $2.50. So, I think that we could be hanging out around $1.50, $2 for the coming months. But we'll have to see. Maybe we see some closes above, like, at the end of March 28th, max pain is $1.50. So maybe we see some momentum getting up to around 2, closing the month above $1.50, above 2. That could trigger a gamma squeeze. And then if I look over at this data from Unusual Whales, this is looking at net call and put premium. This is over the past 30 days, but if I do just look over the past day, so this is going to be from the 3rd, we can see that net put premium was increasing, but we also saw net call premium increasing. Net put premium increased yesterday by about $120,000, whereas net call premium increased by about half of that, around $63,500. So that does suggest more bearish than bullish. But if we do look at this over the past 30 days, like I had just shown, that net call and put premium does not really stand out as too notable over the past 30 days. Whereas on, it looks like January 31st, we saw a net put premium increase of about, $500,000, and so that was more notably bearish. Also on that day, we did see a net call premium drop of about $400,000. So bearish, and we did see the stock price following that bleed lower. We did see some kind of unusual data here with net call and put premium both being negative, net put premium being negative by about 1.8 million. So maybe that's a sign that we were near the bottom and we are going to start moving higher. But flipping back over to the chart here, still right around $1.50. And so a couple things that I wanted to go over is, basically different ways that one could play this if we do expect this to be going down to around $1 a share, where I got that alert there. And so one way to do that, one way to take advantage of it, is to buy puts, which, may or may not be of interest. And you can also sell puts, which is, basically I'm going to set some money aside. And if it does close below that strike, then, I would then buy shares at that price. And so thinking about this potentially going down to $1 a share, one could sell a cash secured put with a strike of $1. The premium to sell this, was prior to open, I think 1 cent, which would translate to $1. So you'd get, potentially get 100 shares at an average price of 99 cents each. But that would not be getting filled because, it does look like we're bouncing a little bit in the pre-market. But, placing a limit order to sell one contract at, 1 cent, that could lead to either making, just $1 on that trade if closing above, or if price does go below $1 a share, that could be a nice way to pick up 100 shares at, 99 cents per share, something like that. But, maybe that is not appealing. Could also be buying puts. Buying, selling. Okay, so buying puts to $1, that's pretty risky. I don't think for the expiration of March 7th, I don't think the stock price is going to be going to $1 this week, but $1.50, maybe that's an appealing thing to be selling or to be buying. 10 cents. Maybe it does close below $1.50. We can see from over here that max pain is 2, so maybe that's a little bit risky, but could be selling some puts. I know. Anyways, I'm going to get too lost in the weeds with this stuff here, but I think that that's just kind of like actually a compelling way to accumulate shares is by selling cash secured puts. So if I were to sell this contract here, the $1.50 strike, I could then sell that for 8 cents. I'd get $8. And then if it closes the week below $1.50, I would then pick up 100 shares at $1.50, having made 8 cents on this contract. So that's $8, 100 shares. 8 cents times 100 shares represented by that contract is $8. And so then one would effectively be picking up 100 shares at a price of $1.42. And so that could be an appealing way to be picking up shares, to be, going long, or just to be collecting that premium at, 8 cents there. Another way to kind of play this that I have down here is looking further into the future. That $1 put there, one could be buying some puts with a dollar strike, and let's see. This is in the money, is going to be dancing around as we swing around $1.50. But looking at that $1 strike for the put, one could be buying one of those for 10 cents, which translates to $10, and just swing that for 10 to 20%. I feel like that's actually kind of an appealing play. I think that the price will be going down to $1, and so this could be just kind of a nice way to hedge. And another way to hedge could be by selling covered calls. And I actually sold one at open. My average share price is right around $2. And so I sold one of these covered calls at a price of 2 cents. So I got $2, nothing too exciting. And my average is around $2. So if we do, let's see, close below, or if we close above, $2 a share, then I'd lose 100 shares at $2, but that's fine. My average is around there. But if we close below $2 a share, I get my shares back. I, collect that premium of 2 cents times 100, $2. Not that crazy, but, a little bit does add up over time. So I feel like that's kind of an appealing way to be hedging this. But unfortunately, that $2 strike is no longer, has a premium of more than 0 right now. So kind of unfortunate there. But anyways, looking at the chart over here, levels that I think are going to be pretty important for us to reclaim. Basically, what I have drawn here is the low from February 12th was $1.57. Also, $1.60 over here. Those are going to be very important levels for us to reclaim. And if we can start to close above $1.50 on Fridays, that could potentially trigger a gamma squeeze up to around $2 a share where the cursor is, or maybe getting back up to around $3 a share. And then levels that I have marked here to the upside, I do have this purple downtrend, which was like this inverse head and shoulders neckline. And from that, I can, draw this little data range going up to that neckline, so the midpoint being around the neckline, and that effectively predicted this move to the upside around $3 a share. That's already played out. That neckline was important in the past, so it may very well be important again in the future, but it might be important as acting as resistance, so good to be cautious of that. And getting back to that neckline would represent about a 30% move to the upside, getting to around, like I said, $2 a share. I think that's going to be an important level, so good to keep that in mind. And then I also have this orange line here, which is at $2.26.3. It looks like that was the low from January 18th of 2024. We did get a bounce here before a very nice move to the upside, hitting a high on May 14th of last year at $4.90, just below $5. And since then, we have kind of faded lower. I think that $2 is probably going to be acting as notable resistance, but if we close on a Friday notably above $2 a share, I think that could trigger a gamma squeeze. If we close this Friday notably above $1.50, maybe that could trigger a gamma squeeze. But if I do look over at the data here, Max Pain is currently $2 a share, so I think that we need to see closes notably above that before we get some notable price action up to around $3. And so, yeah, I mean, I think that this is going down to $1 a share, whether you like it or not. I think it's just good to be prepared for that, whether that's by selling covered calls, or selling cash secured puts. If you want to accumulate more shares lower at $1, I think that could be an appealing trade. Or one could be buying some puts with strikes or expirations well into the future, like in June, maybe later, and with that dollar strike. I think that could be a nice way to make 10 to 20% as it does go down. And so, I personally don't have any puts. I did sell a covered call this morning at open that expires this Friday. And so if we close above $2, then, I am out some shares, but that will have been taking some profits. So lower in that risk, I think it's important to be doing with what we're seeing in the market right now. But yeah, so for me, I am just waiting to see if this does hit $1.34. If it does, I'll add a little bit more to my position, but not much, as I will be waiting for $1. But if we don't hit 134, maybe we start to see a gamma squeeze, as we do have a good amount of short interest, and that could be, squeezing the stock higher. But again, I think that we're going down to 1, perhaps before we get up to 3. So do keep that in mind. But, as always, those are just my thoughts. If you found them helpful, make sure you like the video, share your thoughts in the comments down below, and make sure you subscribe to the channel for more videos like this. Thanks a lot for watching, and I'll see you guys later. And so, yeah, I'm just going to release that as a video. Hopefully that was helpful. Went on some kind of rambles about options, but it is what it is. And Jose is saying UVIX is above 40. Dang. Yep. So, I got to adjust that green box over there. So, yeah, I think it's kind of, I wish I wouldn't have trimmed this at, exited my UVIX position at, 20% profit. I could have made a little bit more, but it is what it is. I think it's good to kind of be sitting on hands. And let's see, where's Tesla at? I was going to check it on my phone, but I'll just pull it up here. Tesla is below 270. So for me personally, I'm going to add a fraction of a share to my position because, we are at this confluence of levels. I think it will be acting as support, but maybe we do see it dip lower, maybe getting closer to 200, or maybe fill in this gap down here. That was, we had this island gap over here. Maybe we head back to that level around 200. So anyways, I'm going to end this stream so I can focus on my trades, and I hope you guys can as well. Thank you so much for hanging out. If you haven't already, make sure you like the video. If you're not a subscriber, make sure you subscribe if you want more videos like this. And hopefully you guys have a nice day trading. For me personally, I'm probably going to be sitting on my hands for the most part.